All right, let's have a proper chat. The word investing gets thrown around, doesn't it? It sounds a bit posh, a bit complicated. People in suits, shouting down phones, massive glass buildings. But honestly, it's not like that anymore. Investing is another way to make your money work for you. Instead of it just sitting there doing nothing, it's a helping hand for your future self. I've met so many people who are terrified, thinking they'll lose everything in a day. It feels like a risky gamble, I get that. But here's the thing. We need to break down that fear. Finance has been made to feel exclusive, like a club you're not invited to. That's not right. With a bit of know-how and a clear head, anyone can start. You don't need a fancy degree or a secret password. Take small, sensible steps. Not jumping off a cliff. More like learning to ride a bike. You might wobble at first, start with stabilizers, stick to the pavement, and soon enough you're off. Here's why we talk about this. Money in a normal bank account loses power every year because of inflation. It's sneaky. 10 quid today won't buy as much in 5 years. Prices go up, your cash doesn't. Investing can help grow money faster than prices rise. It's about taking control of your financial future. This isn't about getting rich overnight. Forget that noise. Be smart, be patient, be a little brave. Know you can build something with small decisions. Right, let's get down to it. What actually is a stock? Forget the complicated charts and the confusing numbers for a minute. Imagine your favorite coffee shop, the one on the corner you go to every morning. That shop is a business. Now imagine the owner wants to expand, maybe open another shop in the next town over, but they don't have enough cash. So they decide to split the ownership of the entire business into tiny little pieces, like a massive chocolate bar. Each one of those little squares is a stock or a share. They're the exact same thing. When you buy a stock, you are literally buying one of those tiny pieces of the company. You become a part owner. It's as simple as that. You won't be making the coffee or deciding on the new syrups, but you own a sliver of the business. And if that coffee shop does really well, opens more branches and makes more money, the value of your little piece goes up. People are willing to pay more for it because the business is more successful. That's how you make a profit. You've bought a share in something that has grown. So why do people invest in these stocks? Well, it's for that potential growth. It's the belief that the company you've bought a piece of will do well over time. Think about the massive companies you know, the ones that make your phone, your trainers, or the streaming service you watch every night. Years ago, they were much smaller. The people who bought shares in them back then and held on have seen the value of their bit of ownership grow massively. Of course, it works the other way too, and it's important we're honest about that. If our coffee shop starts getting bad reviews or a new competitor opens up across the street and is much more popular, people might think the business isn't worth as much anymore. The value of your little piece could go down. This is the risk part of investing. The price of stocks goes up and down every single day. The trick, which we'll get into, is not to panic about these daily wiggles, but to focus on the bigger picture. One of the biggest myths that stops people from starting is the idea that you need a massive pile of cash. You see films where someone says, invest 100 grand, and you just switch off. But that's not the reality for most of us. The brilliant thing about investing today is that you can start with whatever you're comfortable with. Seriously, whether it's the price of a few coffees a week, say 20 pounds, or a bit more like 100 pounds a month, you can get started. The amount isn't the most important thing at the beginning. The most important thing is just to start. Think of it like building a snowman. You don't start with a massive, perfectly formed sphere. You start with a small snowball, you pack it tight, and you start rolling it. As you roll it along, it picks up more and more snow, getting bigger and bigger with every push. Investing a small, regular amount of money works in a very similar way. This is a powerful concept called compounding. It's basically your money making money, and then that new money making even more money. It's a slow process at first, but over time it can have a huge effect. Let's imagine you start investing just 50 pounds every month. In the first year you've put in 600 pounds, it might not feel like a lot, but let's say your investments grow a little bit. The next year you're not just earning growth on the new money you're putting in, you're also earning it on that original 600 pounds and the little bit of growth it already made. It's a snowball effect. This is why starting early, even with a tiny amount, is so much more powerful than waiting to start with a big lump sum years down the line. You're giving your money more time to roll and grow. So the first practical tip is this. Figure out a small amount of money you genuinely wouldn't miss from your monthly budget. An amount that, if it disappeared tomorrow, wouldn't stop you from paying your rent or buying your groceries. This makes the whole process less stressful. It takes the fear out of it. You're not betting the farm, you're just planting a small seed, and you can always increase the amount later on as you get more confident and your income grows. The key is to build a habit, a routine of putting a little bit aside for your future. Okay, so you've decided to start. Brilliant. The next question is, what do you actually buy? You wouldn't buy a car without checking its MOT, or a house without having a look around first, would you? Investing is the same. You need to do a little bit of homework. This doesn't mean you need to become a financial expert overnight or read 100-page reports filled with jargon. It just means getting a basic feel for what a company actually does and whether you think it has a good future ahead of it. This is your money, after all. A really simple place to start is with what you know. Look around you. What products do you use every single day? What brands do you love and trust? Do you always buy the same brand of trainers? Is your whole family obsessed with a particular streaming service? Are all your friends switching to a new type of electric car? These are all businesses you can invest in. Starting with familiar companies makes research less intimidating. You already understand what they sell and why people like it. Once you have a company in mind, just do some basic digging. Start with the company website. Look for investor relations. They often have simple presentations about what they do and how they'll grow. Or use a search engine. Type company name stock, and you'll get loads of info. Ask yourself simple questions. Does this company make a profit? Are its sales growing? What are the big risks it faces? You're building a story about its future. The homework isn't about perfect predictions. It's about investing with your eyes open. Make an informed choice, not a random punt from the news. Investing in things you understand gives you confidence. It helps you stick with your decision when markets get shaky, because you have a reason for owning that piece of the business. You believe in its story, not just its price. That's a massive difference. This is probably one of the oldest and wisest bits of advice in the world of money, and well, it's so important. The idea is simple. Don't risk everything on one single thing. Let's go back to our coffee shop example. Imagine you put all your investment money into that one local coffee shop. You've bought loads of shares. For a while it does brilliantly, but then a massive global coffee chain opens up right next door. Your little coffee shop struggles, and the value of your shares plummets. Because all your money was in that one business, you've taken a really big hit. Now imagine a different scenario. You put a bit into the coffee shop, a bit into a company that makes running shoes, a bit into a technology firm that makes smartphones, a bit into a company that produces medicine. This is called diversification. It's a fancy word for spreading your money across different industries. It's like having a safety net. Not all your hopes pinned on one outcome. If one investment struggles, it's a shame, but not a disaster. The running shoe company might be booming because everyone's into fitness. The tech firm might have released a best-selling phone. The success elsewhere helps balance the poor performer. Spreading risk makes your journey much smoother. One company's ups and downs won't cause a panic or wipe you out. For a beginner, this might sound complicated. How do you buy bits of lots of companies? This is where funds and ETFs, exchange-traded funds, come in. Think of them as ready-made shopping baskets of stocks. Buy one share of a fund, and you get tiny pieces of hundreds, even thousands of companies at once. Instant diversification. One of the easiest, most effective ways for new investors to start without buying dozens of stocks. Look, everyone makes mistakes, especially when they're starting something new. It's part of the learning process. But in investing, some mistakes are more common than others, and knowing what they are can save you a lot of stress and money. The biggest one, without a doubt, is emotional investing. This is when you let fear take over and make rash decisions, or when you let greed take over and make rash decisions. The stock market is going up and up, so you feel FOMO, the fear of missing out, and you pile all your money in at the very top just before it falls. Then there's the other side of that coin. Panic selling. The market has a bad week and the value of your investments drops a bit. You get scared. You see the red numbers on the screen and your stomach lurches. Your first instinct is to sell everything to stop losing any more money. But often, this is the worst thing you can do. You're essentially locking in your losses. History shows us that markets tend to recover over time. Selling in a panic is like jumping out of a roller coaster halfway through a dip. You miss the climb back up. Another classic mistake is trying to time the market. This is the idea that you can perfectly predict when stocks are at their lowest point to buy and at their highest point to sell. It sounds great, but even the professionals who do this for a living get it wrong all the time. It's basically impossible. People who try to do this often end up sitting on the sidelines with their cash, waiting for the perfect moment to buy, and they miss out on growth. A much simpler and more effective strategy is time in the market, not timing the market. Just being invested for a long time is what counts. Finally, a really common trap is listening to hot tips from a mate down the pub or some random person on social media. They'll tell you about some tiny unknown company that's guaranteed to be the next big thing. Be so careful with this. It's pure speculation, not investing. It's gambling. For every one of those stories that works out, there are thousands that end with people losing all their money. Stick to your own plan, invest in solid, understandable businesses or diversified funds, and ignore the hype. A boring investment plan is often the most successful one. If there's one single thing I want you to take away from all this, it's this. Investing is not a get-rich-quick scheme. It's a get-rich-slow scheme. And that's a good thing. It's about patience. It's about planting a tree, not buying a lottery ticket. You don't plant an acorn on Monday and expect to be sitting in the shade of a giant oak tree by Friday. You plant it, you water it, and you let it grow year after year. Your investments need that same kind of time and patience to really flourish and do their work. The stock market is famously volatile, which is just a word for something that goes up and down a lot. There will be days, weeks, and even entire years when the value of your investments falls. This is completely normal. It has happened again and again throughout history. The key is not to get spooked by this short-term noise. Don't check your investment app 10 times a day. It will drive you mad. It's like weighing yourself every hour when you're on a diet. The small fluctuations don't tell you anything about your long-term progress. Let's think about it with a real-world example. Imagine you had invested in the market back in early 2020. A few weeks later, the global pandemic hit, and markets around the world fell dramatically. If you had panicked and sold everything, you would have lost a lot of money. But if you had been patient, taken a deep breath, and done absolutely nothing, you would have seen your investments not only recover but go on to reach new highs over the following years. The people who lose money are often the ones who react to the short-term drama. The people who make money are the ones who stick to their long-term plan. This is why it's so important that you only invest money that you won't need for at least 5 years, ideally longer. If you're saving for a house deposit that you need in 6 months, the stock market is not the place for that money. It's too risky in the short term. But if you're saving for your retirement in 30 years' time or for your kids' future in 15 years, then you have the time to ride out the bumps in the road. Time is your greatest asset as an investor. It smooths out the scary drops and lets the power of compounding work its magic. Right, we've talked about the why and the what. Now let's talk about the how. This is the practical bit that often feels like the biggest hurdle, but it's easier than setting up a social media profile. To buy stocks or funds, you need a special type of account. In the UK, the most common tax-friendly one for beginners is a stocks and shares ISA. The great thing about an ISA is that you don't have to pay any tax on the profits your investments make. It's a government incentive to save and invest. So, how do you open one? You don't go to a bank in a suit anymore. You do it on your phone or laptop. There are dozens of investment platforms and apps. You'll have seen their adverts around. Hargreaves Lansdown, AJ Bell, Vanguard, Freetrade, Trading 212. They are the online shop to open your account and buy investments. Check comparison sites to see which suits you. When you're comparing, look at the fees. This is really important. Some charge a percentage of your total investments, some charge a flat fee every time you buy or sell, and some have a monthly subscription. For someone starting with small amounts, a percentage fee can be cheaper. Understand what you'll be paying. Fees can eat into your profits over time. Think of it like choosing a mobile phone contract. Once you've picked a platform, opening the account is like any online sign-up. You'll need your personal details, your address, and your national insurance number. You'll also need to pop some money into the account, usually with a simple bank transfer or by setting up a direct debit. And that's it. You're ready to go. You've taken the biggest step. From there, you can browse the funds available on the platform, browse stocks, do your research, and make your very first investment. It might feel nerve-wracking, but it's also incredibly empowering. So, here we are. We've been on a bit of a journey. We've demystified the jargon, we've looked at what stocks are, and we've walked through some simple, practical tips. We've talked about starting small, doing your homework, spreading your risk, avoiding silly mistakes, and most importantly, being patient. The world of investing might have seemed like a locked room before, but hopefully, you can now see the door is wide open. It's not a secret club for the rich. It's a tool for everyone who wants to build a better future for themselves. Don't let the pursuit of the perfect plan stop you from just getting started. You don't need to know everything to begin. You just need to know enough to take that first small step. Open an account. Set up a small, regular monthly investment into a simple, diversified fund. Think of it as an experiment, an investment in your own education. The learning you will get from actually doing it, from seeing how it works firsthand, is far more valuable than reading another 10 articles about it. Action is the best teacher there is. Remember why you're doing this. It's not for some faceless number on a screen. It's for you. It's for your goals. It's for your dreams. It's for your security. It's for the freedom to make choices later in life. It's for giving your future self a bit of a break. Every small amount you put away today is a vote of confidence in that future. It's a quiet act of optimism. You are planting the seeds now for a tree you'll get to enjoy for years to come. That's an incredibly powerful and positive thing to do. So, what are you waiting for? The best time to start investing was 20 years ago. The second best time is today, right now. Take a deep breath, push the fear aside, and take that first step. It doesn't have to be a giant leap. A small, simple, sensible step is all it takes to begin your journey. You have the knowledge. You have the tools. You are more than capable. Your future self will thank you for it. Go on, you've got this.